Good morning. Good morning, everyone. Good morning and Happy New Year. You're welcome to Norrenberger's 2026 Economic Outlook. My name is Abigail Kazim, a research and insight analyst with Norrenberger, and I have here with me my colleagues, Samuel Oyekomi, the group lead for research and insights for Norrenberger, and Victor Oyema, head of investments, Norrenberger Asset Management. Hi, Samuel. Hi, Victor.
Hi, Abigail.
Hello, Abigail. Good morning. Thanks for having me.
Thank you. Thank you. So we'll be starting with the global economy. We'll take you through. So we'll start first by taking you through the happenings by reviewing 2025. We'll start from the global economy, take you through what we're expecting to see in year 2026. Same goes for domestic economy and domestic markets as well. And then we'll do we take question and answers. We take questions from the attendees. So if you have any question, please do use the Q&A box for your questions. Please drop your questions in the Q&A session as we go along. And we already have a particular time allocated to take questions at the end of the session. Thank you very much. And I'll be handing over to Samuel Oyekomi to take us through the global economy.
Yeah, thank you very much, Abigail, for that. And again, welcome everyone for joining us today. So this is pretty much a monthly financial market review. We'll be doing this every month where we review the financial markets globally and locally, and then give also our outlook based on our analysis of what we think is going to happen for the coming months. But this session is, we want to start with a 2026 economic outlook to give our views on our outlook on both global, local economy as well as markets. We start with the global market, and quite a number of things happened in 2025, right? From the Donald Trump varying tariffs across different parts of the world. We also had the exacerbation of the US-China trade war. And a whole lot of that also impacted prices both in Asia and also in the US. We also saw the risk of the US falling into a recession at some point in time. So if you look at the charter book right by our right, you can see the US economy at some point had negative growth in terms of GDP movement. And we saw high prices also in some later areas of the world, especially in the US as a result of the tariffs. Businesses, in a bid to be able to fend off or to be able to hedge against this tariff, had to increase their inventory, and so a lot of buying pressure at some point earlier in the year, and that also triggered a significant growth in terms of the US economy, and they were able to reverse back from the recession. But one of the things that we could take note from 2025 was that there was significant investment in AI. AI has pretty much become a mainstay in the last few years. We saw venture capitalists invested a little over $190 billion in AI startups. That was in the first 10 months of the year. We've also seen the likes of Tesla, Microsoft, Google done quite a number of investment in AI. And as a result of that, we saw AI stocks also rally during the year. Again, going into 2026, there are quite a number of things that we think are quite important to consider. One of it is that there's a mid-election in the US, and that could also reflect on policies going forward. We've also had to change, there's possibilities for a change in the US Fed chair and person of power, right? And as we know, since the coming in of President Donald Trump, we've had quite like a loggerheads. He prefers significantly low interest rates. But the US Fed, considering the fact that prices are still high, a little higher than its inflation target, they seem to be quite cautious when it comes to monetary policy cuts. Although, yeah, we saw some cuts in 2025, but again, as going forward, if we don't have any more price pressures, of course, there will probably be no reason to not cut interest rate. But the chances are the new person coming in would likely dance to the tune of Donald Trump, which is to keep interest rates at very low levels. And what that could also trigger is a potential capital flight. We also have some back and forth around reserves. We see banks across Asia who has reserves in the US. Of course, if you have low interest rate in the US, you can see a lot of flights, and that could cause pressure for the US dollar. But in the short term, we expect that economy will remain quite resilient across major parts of the world, including both developed economies and even emerging markets. And we also expect that Africa also would remain quite resilient, albeit prices are still relatively high. We had a number of coups also in 2025. But away from that, we believe that the economy will remain strong and resilient. I'll give the baton back to Abigail to take us through the domestic economy.
Succinct point there. Thank you, Samuel Oyekomi, for taking us through review of 2025, for the global bit. So moving on to domestic economy now, and here we have, a scoreboard, an overview of what we saw in 2025 as in Nigeria, right? In 2025, we had key macroeconomic indicators which began to show signs, and we had early signs, right, of stabilization in Nigeria, from inflation dynamics, which moderated significantly, right, from the previously elevated levels, majorly on the back of CPI rebasing that we had earlier in 2025, and also lately this month, precisely on Thursday last week, that was released, and then the MBS stating and having to do some normalization, based on the effect of the earlier rebasing on December figures. And we also had, exchange rate volatility, which eased, significantly on the back of market-based pricing gain traction, fiscal coordination, which also improved alongside tighter monetary conditions. Right. We also had, foreign exchange growing significantly as well for the economy. And some of the notable developments that we also had in 2025, like I've mentioned earlier, is the rebasing exercise that was conducted by the National Bureau of Statistics, not only for the CPI, the Consumer Price Index, also had that for the GDP as well. It also impacted the GDP, which helped us to see, especially for the CPI, helped us to see improved or updated, consumer spending pattern and new things, changing the index from 2009 to 2024, right? Also, there was also following, that rebasing exercise, Nigeria real GDP expanded by 3.79% in the first 9 months of 2025, which, as you see, outperformed the 3.23 that was recorded in 2024, right? And this particular improvement, as we see, reflects an increased activity in non-oil sector, which was as well as early recovery in oil sector as well, with industrial and service sector showing strong momentum, right, for the period. And as at Q4 2024, the Nigerian real GDP was still stood at 4.1 percentage as well. Moving on to we also have the commencement of Dangote refinery operation, alongside some notable improvement that we had in crude oil supply, which all of this, put together, has played a very significant role in revitalizing Nigerian oil sector.
Okay, so thanks, Abigail. I'd like to speak to there's two sides of the coin, right? Some of the things that we've seen, right, like Abigail had mentioned, we saw quite a number of gains from the previous slide. We see that inflation has gotten better, exchange rate, PMI, a number of things that you probably find in the reds here, things around fiscal environment, crude oil prices hovering around $62 to $65 per barrel, against budget targets of about around $75 per barrel. I also see things around debt stock also not meeting up, of course, continue to increase aggressively and kind of frustrate the fact that can debt sustainability really be something that would achieve going forward. But then again, the question is, with the new tax reform, maybe we can better start seeing some turnarounds in terms of our fiscal numbers going forward. But then again, as much as we are seeing positive in terms of the macros, a major problem with the Nigerian economy has been the fact that we are not able to translate some of these macro gains into micro gains for individuals and businesses. At the end of the day, when you have significant growth in terms of economy, PMI numbers, inflation, and is not reflecting in how businesses and individuals feel this, it tends to give you like a challenge, right? And that's pretty much what this chart is just, this slide is speaking to. We have good numbers on the right, yes, as we saw in the previous slide. But then again, businesses continue to complain about things around insecurity, high multiple taxes, insufficient power supply. Earlier in the year, we saw the signing of the Electricity Act, which allowed for businesses and states to have some form of autonomy around generation of electricity. How has that really played out so far? Again, high interest rates. We have been dealing with an MPR of 27.5% for the best part of last year until later part when it was cut by 50 basis points. But then again, cost of borrowing remains significantly high. A number of people continue to deal with high bank charges, right? Different charges, be it stamp duty or be it card maintenance charges. And a whole of some of these things just come together to put more pressure on businesses. Right, and that becomes pretty much like a challenge. So again, the question for the government going forward would be, how do we translate some of these gains that we continue to see on a macro level? How do we translate it into gains for businesses and individuals?
Yes, thank you, Samuel, for that contraction, between what the economy is saying in terms of numbers, and the impact we are seeing on businesses and the average Nigerian citizen. Right. So moving on to the reforms, the major reforms that we're seeing with the current administration. The first would be the FX reform, where the administration announced did some FX reform, some FX unification, and currency reform, with the aim of enhancing transparency, investment signals, and contributing to growth in the external reserve, which we saw growth, extensive growth in external reserve, growing to as much as $45 billion as at 2025. The status would say it's still ongoing, and significant is quite positive, as we had earlier stated. We also saw the removal of fuel subsidy. Where the government, removed or altered, the decade-long fuel subsidy, which allowed, the prices of fuel to float to current market levels. That as well, the significance is also positive, but we've had, short-term cost pressure. This impacted, this hiked, the price of transportation, and also indirectly impacted prices of food, inflation, and all of that over the time. We've also seen electricity reform, where the National Integrated Electricity Policy and the Electricity Act, reform the power sector, enabling the states that we have in Nigeria to generate and distribute electricity, to private sectors, to attract private capital rather. And the impact of this, we would say, has not been upfront, right? Because at the time of preparing this report, but then the reform is still ongoing. A very significant reform that we also saw with this current administration and in 2025, is the NIRA Act, the Nigerian Insurance Industrial Reform Act that came out, to, modernize the regulatory framework that we have around the insurance companies, to further strengthen their capital, digitalize it, and align the industry to global standard. This also has significant impact, and is currently ongoing. A key one, and another one that we also saw, is the financial autonomy that was given to the local government, which says that federal allocations cannot be paid directly, to democratically elected local government, instead of rather than routing them through, state joint local government accounts, like it used to be done, right? This is also still ongoing, and of course the big one that we had, which will also show more about it in subsequent slide, is tax reform. Tax reform that we have, that this also impacted the Nigerian equities market significantly, precisely on the 11th of November, where we saw that the equities market lost over 5%, for the first time in a very long while, due to lack of clarity around that bit. This is currently being implemented. It started in the 1st of January this year, right? So it's too early. We'd say it's too early to determine the impact of that. We also saw, increase in minimum wage that was done to 70,000 naira from 30,000 naira that it used to be before, and also the review period was also updated or amended from 5 years, to 3 years. And this also, the impact is quite medium, but it's still ongoing. So moving on to, what we saw in respect to precisely for the tax reform, for the Tax Act, the NRS, right, achieved about 89.6% of its revenue targets for 2025, and then a little over 22 trillion, right, was derived from federation revenues, where we had above 5 trillion naira derived from oil-related taxes, and 17.30 trillion derived from non-oil taxes. And like I said earlier, tax reform is definitely a big element in the room, as is definitely the big elephant in the room, and as that impacted the Nigerian equities market significantly last year, like we saw, due to lack of clarity. But of course, later that day, when the Minister of Finance, and then Minister of Finance until we gave further clarity, built channels for clarity about the tax reform, which is what Nigeria needs at this particular time, in that regard. But subsequently, we expect, we hope to pay more attention to this tax reform and see how it will continue to impact the Nigerian economy and the equity as a whole. Right. So these are our key projections for the domestic market. For 2026, we expect to see the real GDP generally, right? First of all, we expect to see that this stability, right, this relative stability that we've seen that Nigeria has experienced for 2025 would ease into 2026, right? Moving the real GDP to about 4%, from within 4 to 5% in 2026, and also the Nigerian headline inflation now averaging about 14.3%, right? Also, and NPR moving to 24%. Now, right now it's currently 27%. So we expect to see further rate cuts as we go along with the first meeting holding in February 2026 next month. But by the end of the year, we expect to see the NPR at 24%, and of course, external reserve, which is currently at $45 billion, expect to see at about a little over $47 billion, and also exchange rates, staying within the average of 1,400 to 1,450, levels, and of course, our NPR as well, still within that percentage. So moving into the domestic markets, I'll ask Sam to take that.
Yeah, thank you very much, Abigail, for that. I'm sorry, I had network glitches earlier. Just like Abigail has said, there's been a lot that has happened so far in recent time, right? And we also expect that to play a huge role going into 2026, one of which is tax law. But coming again to the fixed income market, what we saw in 2025 was that yields began to moderate. And I'm sure that Victor will be able to speak to this later on during our chat, right? On the back of expectations that interest rates would be cut as inflation moderated significantly. Don't forget that we started 2025 with inflation of around 34%, and following the rebasing, we saw it came down to 24, and eventually to the north of 15% by December. And of course, expectations around that is that the CBN should also move in that direction and apply some form of slack around interest rate and cut the MPR, but that didn't happen. But of course, market had reacted to the expectation of that, and we also saw some bills being auctioned, even bonds at lower rates. Of course, there was also reversal at some point following the announcement of the medium-term expenditure framework that was released by the Ministry of Finance, and as a result of the huge budget deficit expected for 2026, we saw the market also reverse at some point. But generally, yields were slower compared to previous year. But then going into the 2026, what do we expect that's going to happen again? We expect that the yields will remain at relative current levels. Then towards the second half of the year, we expect further moderations. Of course, as at then, we expect that the CBN would also start implementing some level of interest rate cuts. Following our projection for NPR this year, we expect to have at the very least 200 to 250 bips cuts in the NPR, and that we think is also going to impact what Treasury bills yields and bond yields going to look like at the end of the year. And what that also tells an average investor is that these yields are still very high. And for risk-free instruments like this, it is still very much an opportunity for investors to be able to leverage on them, because the truth is that you might not find these kinds of high yields again in the history, in maybe near-term history. Don't forget that we got to this point as a result of COVID. Then we went into the whole of NSAS, how that impacted inflation, and as a result, there was serious hike on the NPR, high money supply, and a host of many other things. So again, an opportunity for investors to be able to leverage on these current high yields. Moving away from that, again, we also saw the moderations in terms of Eurobond yields also on the back of some interest rate cuts around the world, both in the US, in the UK, and in Canada. And away from that also, here in Nigeria, we also saw a review of our credit ratings, both by Moody's and Fitch. Again, there was also the removal of Nigeria from the task force for anti-money laundering and all that. That has also had some positive sentiment around the Nigerian economy. There was even a Eurobond auction at some point in the year that was significantly oversubscribed. And what that also gives an indication is that foreign investors are particularly also interested in the Nigerian market. One is that we offer very high incentives for foreign investors right now compared to what you find in different treasury instruments in the US. So of course, that's that. And then aside that also, some of the reforms also seem to be going well with foreign investors, one of which is the relative stability that we've seen in terms of interest rates movement in recent time. Okay, so to the equities markets, right? Quite interesting 2025. The market did relatively well again compared to the previous year. I think last year, 2024, the equities market did somewhere around 30% in terms of return. But for the year 2025, market did a little over 50%, and for most parts of the quarters, the market continued to rally right in the early. But one thing that we also find quite interesting is that a number of those gains were driven by fundamentals, right? Earning length performance rather than sentiment. Of course, we had sentiment in a number of stocks. So you see the likes of NCR doing triple-digit growth and the likes. The same way we saw 2 years and 3 years ago, where the likes of Julie also led the gainers. But in terms of the market movers, right, we see quite fundamentally sound companies that led the chart. So you had the likes of Boa Foods, MTN on the back of the FX losses that they've experienced in the last 2 years, following the devaluation of the naira. But then again, they also kind of restructured their book. They had like a deal with the IHS earlier in the year that restructured some of their FX denominated liabilities, of course, that helped them also be able to offset some of those things, some of those items on their balance sheet that causes them huge FX losses. So on the back of that, and then the fact that we now have relative stability on the exchange rate front, MTN, of course, reported significant gains in terms of profit and looks more inclined to be able to pay dividends. And of course, as a result of that, we saw the stock rally over 100% during the year. We also see the likes of Boa Cement, Dangote Cement, GTCO also leading in terms of market movers. But then again, what we also saw is that the equities market became more efficient in terms of the fact that information now start leading the market charge. At some point in Q4, following the conversations around capital gains tax on the back of the tax reform, we saw the market record a significant dip, right, following concerns that CGT could be anti-development in terms of the capital market and the equities market as a whole. But of course, following some form of clarification, as said by Abigail earlier, we saw the market also revamped from that losses. And again, when you look at it from a sectorial point, like I mentioned, things around FX losses, fundamental sound gains in terms of profitability, you see that the likes of consumer goods pretty much led the charge in terms of sectorial performance, gaining over 140%. But away from that, banking also did considerably well, considering the fact that they're also trying to raise funding through recapitalization that is due soon. We also had industrial sector also doing quite well, and insurance sector. The only odd one out of that was oil and gas. Of course, international crude oil prices remained relatively low compared to expectations for 2025. And then away from that, also there were a lot of debacles around Dangote refinery, as well as local importers of petrol. And as a result of that, they just not seem so much upsides on the oil and gas front. But then again, there are quite some developments that we're expecting in 2026. The expectation is that Dangote refinery is going to list the market. He had mentioned he's going to list about 10% of the stake of the company on the exchange, and even pay dividends in USD. And the market seems to be positioning, waiting for this listing. We expect it to be quite a high cap type of company, and on the back of some base case gain of the market of around 20 to 30%. We think that the equities market capitalization is primed to reach 135 trillion this year. And I think that's quite interesting, because what it also does for us is that you have quite a robust market. Again, we've seen quite a number of capitalization regulations, even across the capital markets, the insurance industry, banking industry. Everyone is trying to raise capital. And what that does is that it increases the depth of the capital market, the equities market specifically. And what that does again is helps to drive the goal of the government as they move towards reaching a $1 trillion economy in 2030. How well we are going to be able to achieve that remains a question, but it all seems to be towards a journey of hitting a $1 trillion economy in 2030.
Thank you, Samuel, for that succinct and very, detailed breakdown on Nigerian equities markets and how we've been able to, move and performed very well, particularly in the last half of the year where we see the major gains. Now we're moving into just, brief questions that we have for, yes, thank you so much. Please keep the applause coming. We know that this webinar has been quite insightful thus far. So we have some questions, for just, questions to provide further clarity, for Samuel and of course for Victor Oyema, Head of Investment Management, Norrenberger Asset Management. But while we're at that, please do remember that you can drop your questions in the Q&A session, right? Please do drop your questions in the Q&A session. We're on the lookout for that, and we'll be sure to take them right after now. So my first question goes to you, right, Victor William. Hi, Victor.
Hi, Abigail.
I once again. Yes, thank you. So reflecting on, the market performance of 2025, and, someone already buttressed and spoke extensively, right, on how the Nigerian equities market has performed, the major movers, and took us through the quarterly performance and all of that, even to the indexes, the five broad indexes that we had, even the NGX 30, the looks and all of that, saying all those, brilliant and amazing performance that we witnessed in Nigerian equities market. What can we now expect, right, in this year, 2026?
Okay, thank you so much, Abigail. As Samuel said, 2025 was a very, very interesting year. I think for me, it was more of a repricing year. We saw a lot of reforms, policies come into play in 2025. We saw inflation easing from 30% levels to about 15%. We saw FX liberalization. We saw interest rates move from 27.5 to 27%. We saw fixed income yields also decreased significantly. At some point in 2025, we had yields at 22% on the bond side and about 24% on the treasury bill side. But we saw that decrease significantly to about 17, 18 by the end of 2025. So a number of things happened 2025. Even on the alternative space, in the commodities market, we saw gold also do really well. I think gold did about 70% from about $2,500 to about $4,000. We also saw silver do over 100% from about $28 to around $70 at the end of the year. So a number of things. As Sam also said, sectoral wise in the equity space, we saw consumer goods do over 100%, which is quite interesting. So 2026 moving forward, I think is also going to be an interesting year. We might not see a lot of dramatic things take place, but it will be more of a very stable year. So we'll see how those reforms that the government came up with would have a say this year. For me, on the inflation side, of course, we expect inflation to decrease significantly. I think around the 14% thereabouts. In the investment space, so if we look at fixed income, for fixed income markets, we still expect it to be a little elevated at the start of the year. I think we had the first treasury bill auction about 2 weeks ago, which closed around 18%. It was a bit of a shock where it closed, but we expect yields to decrease towards the middle of the year, half year, end of the year, on the bond side, on the treasury bill side. Also for NPR, we expected maybe more than one cut last year. We only had one cut, about 50 bips from 27.5 to 27, but we expect that to be a little bit more aggressive this year. I think for us, but we see NPR around 25% by the end of the year. And of course, we know how that would affect the fixed income market and the market at large. So if that happens, we would see fixed income yields taper down significantly compared to where they are now. Even on the equity side, if we see those interest rates decline significantly, what usually will happen is there will be capital flow from the fixed income space to the equities market because investors are looking for better returns. So they would naturally move funds from the fixed income market where yields are low to the equities markets where they would expect to get a little more returns on their funds. So we're expecting growth to improve this year. Investors' confidence is also good for Nigeria at the moment. The outlook is good. We've had ratings, rating improvements for the country. We've also seen a lot of FX inflows as well. So it's interesting for 2026 across asset classes as well. So equities, fixed income, we expect them to still do well. Equities, I think the pricing for equities, for a number of equities right now is still pretty good. We'll probably see pricing go up for many of these equities by the middle of the year, towards the end of the year. One thing to also note for equities is we'll probably see two major players come into the market, as Sam earlier mentioned, Dangote Refinery, as well as probably NNPC as well. That will probably give the market cap another 30-40%. So it is interesting to see what 2026 has to offer. A lot of economic activities will also be there.
But also for me, one thing that would shape 2026 will be how the government is able to manage borrowing cost. Debt services at an all-time high. So it will be interesting to see how they're able to manage cost of borrowing, as well as also managing interest rate levels, because rates have to be attractive for investors to still push funds into the fixed income space and even into the equities market. So it'll be interesting to see how the federal government as well as CBN, they are able to manage debt servicing and also even the budget deficit, how they intend to fund that as well. Because of course we expect them to do a lot of local borrowing. I think about 80% of what they need to borrow will come from the local market. So it will be interesting to see how that plays out. So yeah, but largely I expect it to be a pretty stable year, based on all we've seen from the previous year, the last 2 years, the reforms, the policies. So yeah, I expect 2026 to be an interesting year, but more stable than dramatic compared to what we've seen in the last few years.
Thank you, Victor. So most stable year it is, with respect to equities market. And I hear you speak, tilt slightly to the fixed income, area. So let's, dig deeper into that. With the interest rate easing slowly. I mean, MPR is now 27%, and we expect that the MPC, would cut rates, further this year. And then we still see the yields in the fixed income market are still relatively attractive in the fixed income market. So what area now? For the fixed income, for the equities market, you just told us that we expect to see some stability, some growth, particularly in respect to the guys that we expect to see come into the market, to list into the market in this year. So comparing fixed income to equities market, which of them, right, would you see best opportunities this year?
Okay, thank you, Abigail. So that would depend on a few things. So for fixed income is usually what we call like a defensive sort of asset class, where you know what you're getting into, you know where you're coming out, So equities usually would give you better returns. Historically, the equities market has proven that, right? So you would naturally get more returns on the equities side but of course, with the equities market, it comes with a little bit more risk. But for me, from an investment perspective, what I would advise is to have a diversified portfolio that has allocations in different asset classes. So across fixed income, equities, even USD investments, as well as alternatives and commodities, right? So what the fixed income will do for you is it gives you some sort of buffer in terms of what where you're getting into, where you're getting out. The equities, depending on what you pick, you could get very good returns. For USD asset class, so that just gives you some sort of hedge against inflation, right? So it's also important to look at that. And also in the commodity space, we saw what gold and silver did last year, right? So I think it's also important to have some allocation there. So generally, equities will give you probably the best return over a long period of time. We've seen that over the last few years, but it's also very important to have a diversified portfolio so that you are not affected too much when one asset class is not doing very well. So it's good to diversify, have a bit of a balanced portfolio across all asset classes to give you the best possible return, and also to avoid significant shocks when any asset class doesn't do so well.
Absolutely. Thank you, Victor. Diversified portfolio will definitely do the trick, to be able to eat from here and eat from there and still, maintain relative level of stability. Thank you, Victor. So moving to Samuel now, with the newly introduced tax reform, as we've mentioned a lot on this call as the, elephants in the room. There's been a lot of debates, right, and some level of uproar, really, in terms of this tax reform. Been seeing a lot of people saying different things here and there. So from a research perspective, right, how do you expect that this reform would impact economic activity, corporate earnings, and general market sentiments?
Yeah, thanks, Abigail. I think just as you mentioned, right, the tax reform is quite significant. That seems to be like the biggest deal going into 2026. But again, I think one of the fears, again, major fears around the fact that a number of people still do not understand a number of things around the tax reform. And on the back of that, it's just causing quite a number of panics as we see from different forums, right? One of the things that I expect to see in 2026 is that for those that are informed about the implication of those tax reform, we start seeing a lot more strategic move in how they do business. So coming, for example, to the CGT, for example, for equities, right? Before you are entitled to pay the CGT, right, there are caveats around the amount of transactions you need to do and how much you must have made as gains from that. I think somewhere around the region of 10 million, 10 million naira or so, and then the transaction worth about 150 million naira. Now, what you find people do is that they would not invest in equities using a single portfolio anymore. They start seeing individuals having pockets of companies that they use to invest. And then because there is also the definition around small businesses, right? Things around your revenue annually being around 150 million naira, then your fixed asset value around 250 million naira. By the time you have several different broken down companies, you'll find out that you will not meet that threshold, and eventually you might not have to be paying taxes. So what you find is that a number of individuals and businesses who understand the tax law will now start looking for smart ways to reduce their tax burden. For individuals, for example, who there is an effective, for example, taxable income, right? Understanding that for someone who does business, who, for example, is not doing things around insurance or pension, for those who are smart, who understand the tax law, you start seeing them doing a lot more contributory pension, because what you're doing is that rather than having a higher taxable income, you have a lower taxable income by the time you start investing in yourself. Start paying for insurance, for example. If you pay for health insurance, you don't have to have a separate money from your eventual real income to spend on health matters later in the year. And then when you contribute a lot more in pensions, you don't have to, again, it reduces that cost burden for you in terms of tax payment. So again, I expect businesses and individuals to start thinking around the tax reform. I don't see the tax reform as a problem. I see it as an innovation enabler, something that helps you to look inward, to start understanding what you need to do for yourself and how you can make the most around the tax reform. What I also think is that most businesses will now appreciate the expertise of tax experts now and other advisory service providers. Before now, we probably look at them from the lens of auditors and whatnot. But I think going forward, a lot of businesses will require tax experts to be in their business across every forms of operations, because you also don't want to be found faulty, being default in terms of not filing or under filing or over filing, things around you want to charge VAT for those who you're doing business with, or you also want to withhold taxes. Again, you want to ensure that you tight every loose around that. So I think businesses in that advisory side of things, especially taxation, will do well going into 2026. So for me, again, I expect a lot more innovation around finances 2026.
Amazing. Thank you. Thank you for that explanation, Sam. Right, so we've seen some questions in Q&A session. Please do keep them coming, and we are already answering some. Right, so you can just look through in case you drop questions in Q&A session. You would see that some questions have already been answered. Right. Please keep the questions coming and make sure that your questions are dropped specifically in the Q&A session. So back to you, right, Victor. Let's now go beyond Nigeria, right? Looking beyond Nigeria, let's talk about the global trends. So what global trends do you think might have the biggest impact, right, on the local markets, in respect to investment opportunities this year?
Yeah, thank you, Abigail. So of course, we know that our market is also affected by things that happen globally. So one of the major things that would affect us here in Nigeria will be global monetary easing, right? So if we see the Fed, the US Fed, and of course the European markets decrease interest rates, that also has an impact. And also we'll probably see more capital flows into emerging markets, such as Nigeria, right? So basically, if their own yields on their fixed income markets decrease significantly, we would see movement of capital to emerging markets that provide them better returns. So that's one thing we need to look out for. Of course, policy reversals also can have some say on how the domestic market performs. Global tensions, supply chain disruptions, that could also have some effects on the domestic market. So if we have situations where the global tensions continue, we'll probably see investors pull out funds and just go towards safe havens to just preserve the value of their funds, right? Geopolitics as well. See that could also have an effect. So Ukraine-Russia war, for example, those are things that will affect the domestic markets. Oil prices too. Of course, we know that Nigeria is one of the major producers of oil. So oil prices also would have an effect on us, especially in terms of revenue. So if we see oil prices decrease significantly, so let's say $40 per barrel, that could be a big concern, because what it means is reduced revenue for us compared to when these prices are higher. So some of these would have an effect on the domestic market. So it will be interesting to see how the political tensions, Ukraine-Russia war, let's see if there will be some sort of agreement this year. And of course, Trump with his antics and tariffs and all of that. So all of these, because the world's a global market, right? So all of these would have an effect on our domestic market as well. So we look out for commodity prices, oil, political tensions, US rates, European rates as well. So those are some of the things I think would have a big effect on our domestic market. Abigail.
Thank you, Victor. Thank you for that explanation. And I saw the applause coming in as you spoke, which means that a lot of our participants, resonate or can resonate with the answers you provided. Thank you, Victor. So let's take some questions that are yet to be answered from the Q&A session. So thank you, Michael. Michael, I can see I can see your thank you in the Q&A session. Thank you, Michael. Adeleke says, please, I want you to talk about allowed ETF. And then, so we'll take two questions at once. We'll talk about allowed ETF. Samuel will answer that question. And also, what an anonymous attendee wants to know our advice, for investors who is risk averse and wants to invest in equity markets. Samuel, over to you.
Yeah. So for halal ETF, I think right now, if you look at the NGX, we have the Lotus halal ETF, pretty much mirroring the Lotus index. And what it does is that it has pretty much have like a compilation of companies that are halal compliant. What you find is that businesses that are involved in things you call riba or interest-bearing businesses or alcohol and whatnot, they are not part of those lists. There are not quite many. There's just about 11 or 12 of them on that list. And that list, every now and then, I think every quarter, it's kind of reviewed. I also saw someone's question talking about some specific companies that you can think around when it comes to Sharia compliant, either ETFs now. Of course, there are ETFs is also a function of those stocks. So it's the likes of Nigerian NACO. You have the likes of Boa Cement. Aradel is also in that mix. You have Okomo. You have Jais Bank. NASCON at some point was being reviewed, but there's no conclusion on if it is still part of that list or not. But you also have the likes of Lafarge also in that list. Again, there's also Chemical Allied. So quite a number of those stocks. And historically also have returned some pretty good numbers historically. And I think they're still quite good stocks to consider. For advice for investors who are risk averse, right? Yes, the equities market seems to be quite can always be volatile, and that's why it's a variable income security. But what one of two things can happen, which again comes to the function of what is your investment objective, what is your horizon when it comes to investing. When you have an understanding of why you are investing, it helps you to know what to do. So for one, if you're someone who just wants to take long-term position, you want to use it as a form of preserving capital and appreciating capital over a longer period of time, fundamentally, right, and I think that is a no-brainer, investors in that category would usually go for very sound companies, the companies that have history of paying dividends, that are fundamentally sound in terms of their corporate governance. And there are quite a number of them, the likes of Dangote, MTN, Lafarge. These guys have been in the business for a donkey years and have consistently returned profits, right? So when you look at companies like that, it tends to give you some level of assurance that your capital can be preserved. So even in banking sector, you can still consider people like the likes of GTCO and Zen, even Stanbic, on the back of the strength of Standard Bank, right? So these companies are fundamentally sound and would likely give you some form of accretion for your capital over the long period. But if you're someone who just wants to take profits in the market, then that's where you need to start understanding some fundamentals about what is the outlook for the economy. And that's why we're having this session. Every month we'll review, as you would also see, we'll review our portfolio for 2026 and see how well it's performed. And on the back of that, we'll see areas where we need to increase our stake or reduce our stake, different recommendations based on our outlook for the going month. But then again, beyond that, you can also do mutual funds, right? Mutual funds, if you are someone who do not have time to think about the hassle of choosing stock and picking stocks, can always go for a professional fund manager who can create a list of stocks for you and manage it on your behalf. I know our securities business do that. Fund managing business also, where Victor is, I know he will be smiling where he is. They also do that, of course, depending on your capital. But I know they can help you curate a list of stocks depending on what your objective is. Are you risk averse? Are you someone who is looking to maximize capital as much as possible? And then as a result of that, you'll be able to get value for your money. But again, at the end of the day, you need information either from fora like this or through a professional fund manager or a broker.
Thank you, Samuel. Thank you. I saw a comment in the chat that says that spoke about our analysis being being layman or understandable for an average investor. Thank you, Adekunle. And that speaks to how well we're doing or how we've been doing so far. Thank you for that feedback. So I'd like you to also answer Samuel Adedayo's question. I know Victor already spoke to it in just here and there. What did I ask precisely, right? She said, given the anticipated bearish bias in fixed income space, what strategies would you recommend for institutional investors whose risk appetite cannot accommodate the volatility of the equities market, seeking to outperform inflation and remain competitive to their clients?
Yeah, I think that's quite a spot-on question, right? And if I can take a guess, I believe Adedayo is someone who is in the institutional sales business, right? So again, I think we pretty much spoke to this question at some point, and even Victor must have also alluded to that. You see, the power of portfolio management cannot be undersold going into 2026. If you want to be able to maximize return, you need to understand portfolio diversification, depending on what your objective is. For someone who is in institutional business, of course, who has clients' monies in their pocket and do not want to risk it, getting a professional portfolio person can help you to spread the risk of that portfolio to a point whereby you maximize return. I know Victor's team does some form of portfolio service where they are able to, depending on your objective, either your benchmark is inflation or any other interest rate across the world, they help you spread it across both fixed income and fundamentally sound equities such that they outperform the market. I'll give you a take, right? In the last 2 years, Norrenberger has had something called the equity portfolio model. In 2024, it did the objective of that index was to outperform the market. The ASI did about 30, 33, 34% in 2024. That index did exactly 50%. In 2025, a new index was also released that did 82% against the market that did 50%. Now, that is a function of well-researched portfolio equities package, right, that can help investors to maximize returns in the market. And I know that Norrenberger also have come up with something new for 2026. I think we're going to speak to that at some point. And and again, it speaks to how you need to also improve to expand the opportunity of information to the public. Because like I always say, this is 2026, everybody must make money. And the only way to make money is to stay abreast of information in the market. So of course, for the question for Adedayo, portfolio is very important. If you can offer them a portfolio service that curates fundamentally sound stocks and also diversifies it across other forms of asset class like fixed income, I think such investors or such institutional clients will be able to outperform inflation. Inflation is currently at 15%. I think you can do way more than that in the market.
Thank you for the answer, Samuel. I see that Victor is also responding to some questions in the chat. So please look through the chat, the Q&A session rather. An anonymous attendee, asked about infrastructure bond and what the future of bond holds, in Nigeria. Victor Uyema already answered that in the Q&A session. There's Chijioke as a question on Nigeria's FMCG growth, right? It says Nigerian FMCG markets grew by 54.1% in value in 2025. How much may it possibly grow in 2026? Please give a range. Samuel, that question is for you.
Okay, thanks, Mariga. The question is from Chidreke. So it says Nigeria's FMCG market grew 54%. So again, that's a very daring ask, right? I don't think anyone should if I had that mantle to be able to prophesy, trust me, I would probably be in the Bahamas right now. I would be doing vacation every day. I wouldn't even be working 8 to 5. But yes, consumer goods has potential upsides. So one thing I always say in any firm is that Nigerians will continue to eat. Nigerians will continue to drink. And if you look at the combination of the consumer goods, right, it's a combination of food and drink. Nigerians like party and they continue to party. They continue to do party. Nigerians like food. According to the MBS, we still spend approximately 50 to 56% of our household income on food. So Nigerians will eat. And when you have those understanding of those two factors, right, you also need to understand that this business will continue to make profits, right? If they continue to make profits, it means turnover is going to increase, one. Inflation is moderating. The impact of FX is also not there anymore. A combination of those two things, in slowing inflation and FX stability, means that profitability will increase. When profitability increases, for the bigger guys that are there that of course have history of paying dividends, it means that they will have a lot more to pay to their shareholders. And that naturally amplifies the sentiment around those stocks. So you see these guys will most likely at least outperform the markets. At the very least, they were a major driver of the equities market last year, and I think they are quite significant in how the market is going to pan out this year. Closing our eyes to any form of risk that comes that might come into the year, not forgetting the fact that 2026 is the penultimate year to an election, and there might always be some of those hassles, right? But bearing that in mind, I think consumer goods will do quite solidly well this year.
Thank you, Samuel. There you have it, Chijioke. Little busy. Your question has been answered live. It's very similar to Adedayo's question, and it was answered by Samuel, and was also previously answered by Victor Uyema. We do not have further questions in the chat. Right. So we'll take you right into the later part of our slide, which will show you to show you the performance of our Norrenberger equity portfolio model for 2025. And Samuel had spoken a lot about this. Victor also spoke, a little bit about this during their presentation. I want about Samuel now for further analysis.
Yeah, thank you, Abigail. So I mentioned earlier that we've had the EPM that has done quite well in the last 2 years, and every quarter we look at that index to rebalance and see what based on our outlook of the economy. So for 2026, right, we are coming up with more than just one EPM. So we've always had one EPM. This year we're going to have more than one, and that's on the back that we understand that there are quite different kinds of investors and different things that they look to achieve in the market. But one thing that is very important is that everyone wants to be able to maximize. They will always want to be able to achieve better than the better that the market offers, right? And our EPM is designed to outperform the market. So we have about 4 portfolios for this year. We will be releasing them in time, but this is just like a glimpse of what is to come. This is our Norrenberger equity portfolio model. There's a name behind this, and we'll be launching that soon. So the market should keep their fingers crossed when that comes in. Very, very soon, there is a very well researched, scientifically backed index that is going to come out soon that has historically in the last 5 years outperformed the market, and it's a no-brainer that for the thinking around trend analysis is that history would always repeat itself. For those who make use of technical analysis in equities, history would tend to repeat itself, and we believe that they are good, fundamentally sound stocks to hold. So far this year, this index called NCSI, I will not divulge the name yet until it is out, has done 8.25% against the ASI that has done 6.8% and the NGX at 6.3%. Major drivers of these stocks so far has been the likes of Dangote Sugar, likes of Lafarge, Nigerian breweries. As of today, as of last Friday, none of these stocks have been in negative, but we've had some of them who have not changed, for the likes of Guinness, for example, and Boa Foods. And that gives you an indication of how quick this index is to start driving the market. And I'm sure by the end of the year, when we start doing analysis of the biggest movers in the equities market this year, you will most likely find a ton of these guys in there. They have, many of them have history of paying dividends. They are fundamentally sound. They also have very good corporate governance. Again, I don't want to put out too much information about this, but very, very soon, just keep your fingers crossed. This report will be out for everyone to see, and then you'll be able to adjudge them yourself. Abigail, over to you.
Thank you, Samuel. I completely agree. And as an insider myself, and as one of the people that was privileged to work on documents, I can tell you for a fact that you really need to put your ears out and look out or watch out for that index, right? Watch out for it and make sure that you pump your money into it as much as you can. All right. I'm looking through, I can see further questions. Okay. Appreciations. Thank you very much. Beautiful presentation from Samuel Falodu. Thank you very much. Adekole has a question that says, we're wrapping up now, but let's quickly. Would you advise investors to move from oil and gas into food and drinks? I think this is on the back of Samuel's answer in respect to people always eating and drinking. Would you advise investors to move from oil and gas into food and drink stock in view of high volatility in oil and gas sector worldwide, Samuel?
Yeah, adequately right. So in investment, which I'm sure you most likely know, is that you do not, it's not an expectation that you should get in when the ovation is loud. Oil and gas stocks, yes, have suffered, but what that has also done is that it presents an opportunity for entry. So you always want to enter low and leave high. So I do not think that you should be thinking to run away from oil and gas. If for anything, you might consider going in now because you're going in low. What are the things that has happened globally that could impact crude oil prices? We've seen the issues around Venezuela with the US, although that has not necessarily caused a rally in terms of crude oil prices as many expected. A number of people expected that we'll find it not over $60 per barrel as a result of the arrest and backfires and whatnot with the government on Trump. But that still remains, that remains a factor. OPEC Plus has also not increased supply in recent times. That also means that they're still keeping a leash around supply in the market, which should keep prices relatively stable. For the local market, I think a huge part is going to be the conversations around the NUPRC, Dangote Refinery, and the NNPC. A number of conversations around those three bodies can influence how local oil and gas stocks will perform. So right now, there's a huge discrepancy on, for example, the average petrol prices that marketers from the Dangote Refinery side and then the importers are selling. And that discrepancy kind of gives some level of low confidence in terms of the importers right now. But then again, we're going into the year is just starting. Quite a number of things can still happen to reshape that. And what that would have done is that because you enter at a low price, you can maximize profit. The likes of Seplat are still quite a good stock to still go into, exposed to the FX market. FX is stable, so that presents a good opportunity to also earn FX in terms of dividend. And what usually Seplat offered to investors was also an edge for a number of people who wants to hedge against FX volatility. But of course, we don't seem to have that right now. But one of the caveats that we have in our economic outlook report that is coming out soon is that historically, how well has the Nigerian exchange rate performed during a year before election? Historically, we've not had so many positives in terms of how well the exchange rate performs. So when you have any form of spike or volatility around the exchange rate at some point in the year as a result of maybe political stake or political affairs or whatnot, I wouldn't use a better word for that, you could see some level of volatility in the exchange rate side of things. And what that would do is that every stock that gives you a hedge against FX becomes a gold at that point in time. So I don't think you should stay away. I think if possible, go in at these low levels with the investment horizon of say 6 to 1 year to 2 years, and you probably will get some positives. I hope that answers the question.
You definitely did. And I'm sure the participants agree with me. Right, so let's touch Lichu BZ's question again. She just sent a reminder. Right, that would be your question, Victor. So she said, I wanted to summarize, but let me just read from here. So she said, so I think I am diversifying my portfolio. She said she's a beginner, right? Now my question is this. How can I do a deep research of fixed income investment to know the ones to get into? Same thing applies to fixed but mixed with solid stocks and then fully aggressive commodities and stock, right? And what do you have to say for someone who wants to go on to Pan-African investment? I mean, not just Nigeria alone, but other African countries. Then what's your advice on global stock investments? She said she's a beginner and she wants to build infinite wealth over time, over a long period of time, and then short term as well.
Okay. I'll try to put all of that together and give a bit of response. Okay, so first you mentioned how can you do deep research on fixed investments? So for research, I think one thing you need to do is to always listen to the news, go online, get information across different economic indicators, what the CBN is doing, what the federal government is doing. What that does for you, it gives you an indication on where or on the sectors or where there'll be a lot of interest. So for example, if you're following the news regularly and you see that the CBN is going to have an MPC meeting, and there's a likelihood that they will cut rates, right? So what that tells you is if interest rates comes down, there is a very high chance that fixed income yields will also come down, right? So those are some of the things that so basically listen to the news, do your research by following the economic indicators, announcement by the CBN, the federal government. That gives you an indication into what is likely to happen. You also mentioned something about commodities, going fully into commodities and stocks. While investing in commodities and stocks are good, it's also important to have a diversified portfolio. You don't want to put all your funds in just commodities and stocks, but it's also dependent on what your investment objective is. Ideally, I would advise a bit of a balanced portfolio, right? So as much as you're doing commodities and stocks, you could also have some funds in fixed income and a little as well in cash for liquidity, just in case you need some money to take care of one or two things. And you also mentioned about global stocks. Yes, of course, you can do that as well. Global stocks are good. At Norrenberger, we can also give you some advice on what to do. We also have the platform to even help you invest in some of these stocks if you need us to. So yes, global stocks are good. You also need to do a lot of research to pick the right ones, right? For global stocks. And lastly, you said advice for beginner, the journey to build infinite wealth, a long period, and then short term also. So for me, for anybody that wants to do investment and build wealth over time, the first thing is it has to be disciplined. There's no shortcuts to it, right? Diversify your portfolio as well. Invest in the stock markets. Look at growth stocks. Look at value stocks. Look at fixed income as well. But very importantly, you need to be disciplined and also understand that building wealth takes time. There's no shortcut to this, so you need to take your time, build it gradually, and stay disciplined throughout the course. Yeah, thank you. Abigail, over to you.
Yes, thank you, Victor. Thank you for that response. Thank you, everyone. Thank you to our amazing participants. And thank you, Samuel and Victor, for joining me on this conversation today. I'm sure that every participant or everyone that participated on this call has gained 10 to 20 things, not a thing or two. Right. Thank you for joining us. One thing you do, and one thing that you'd find out that has been consistent through all the answers that we provided so far is that you can get your Norrenberger is a place that you can come. You can come to us and we'll help you if you're not sure what to buy and whatnot. We can help you create, right, a list of stocks, and help you that can suited for your investment goals or your financial goal, long term, short term. You just come and Norrenberger will help you do that. You can also reach out to our securities company, Norrenberger Securities Limited, as your broker, to also advise you, help you place your trade whenever you need them. Right. You can see a question on mutual fund, but I think Samuel and Victor laid emphasis on mutual fund while we were at it. So thank you very much for joining. Do ensure that you follow us across all social media platforms on Twitter, Instagram, Facebook, LinkedIn. We're simply Norrenberger, right? So just search for, the spelling is right on the screen. So just search for Norrenberger across social media platforms and do well to follow us. And like we said earlier, be at alert, right? And be ready to invest, put your money in the index that we mentioned that is coming out very soon, and also be ready to this is just a snippet. What we presented today is just a summary from our very robust economic outlook that will be out very, very, very soon. So please be on the lookout for that as well. Till next time, do have a great day, and we hope to see you next month. Remember that this webinar holds every month, right? First Monday of every month. See you next month. Thank you for joining.